Rules of the Startup Game. The Startup Guide to Startups.
Hello and welcome to Rules of the Startup Game. This is the Startup Guide to Starting Up. You want to take the plunge? Well, we'll tell you how to. Contracts, government permissions, registrations, term sheets, shareholder agreements, all Greek and Latin to you? Well, stay with us for the next few weeks and we'll give you the simple English version. Today, on our very first episode, we begin at the beginning because that's where Aaron and Roshan are. Aaron D'Souza, an IIT Bombay graduate who last year, along with friends Gaurav and Vishal, co-founded Wired In Interactive, a mobile applications venture.
I was always interested in starting up my own company while I was studying in IIT. At the time of graduation, because I wasn't ready, I decided to take up a job at Oracle. But after working there for a while, I realized that this is not something that I wanted to do, and I decided to start up my own company. So I got in touch with Gaurav and Vishal, and we discussed on a couple of ideas. We realized that the mobile space is something that has changed a lot in the past couple of years, and the mobiles have become a lot more from being just a phone and a messaging service. It's transformed to a personal computer that you can hold in your hand, which is why we decided to set up a mobile applications company.
25-year-old Roshan Dandke is betting his dreams on a real estate advisory business, a venture that will guide investors to investing in specific realty projects.
The real estate sector in our country has been plagued with many issues. At the same time, we see consistent growth in it. We see there are many opportunities which are being lost because investors are shying away from the projects. Me and my friend once were discussing business idea and we felt that we can do something about it. We felt why not form an advisory firm where we channelize the investors' fund in the most efficient way and reap benefits. At the same time, keep the developers insulated from the legals and the compliance hassle as much as possible.
Dreams are free, but businesses need a structure, and it's best to pick the right one right at the beginning. A sole proprietorship, as the name suggests, has a single owner. For tax and legal liability purposes, the owner and the business are one and the same. So if the company owes money to a creditor and fails to pay up, the owner's personal assets can be sold to recover that amount. A sole proprietorship needs no registration if the business does not require a license from local authorities or the health department. Typically, small independent shops that sell groceries, garments, furnishings and the like use this structure. A private limited company is the most commonly used structure of incorporation as it limits the liability of its members or shareholders. It requires a minimum paid up capital of 1 lakh rupees, a minimum of 2 shareholders and a maximum of 50, and at least 2 directors. A private limited company restricts the right to transfer its shares. A public limited company, on the other hand, has no such restriction but has to have a minimum paid up capital of 5 lakh rupees, at least 7 shareholders and 3 directors. A public limited company can invite the public to subscribe to its securities by way of a prospectus. The youngest corporate structure is a variation on the good old partnership, except this one comes with limited liability and needs just 2 partners to get started. Limited liability partnerships, they come with less paperwork, but we'll get to that later when we discuss registrations. Before that, both Aaron and Roshan need to pick a structure best suited to their individual business needs. To do that, Aaron heads off to meet corporate lawyer Anu Iyer.
Yeah. Hi.
So to give you a brief overview of what we do, we are a mobile application and a web application company. So it's me and 2 other founders, and we were having this discussion of what entity to form, whether we should go forward with an LLP or a private limited. So what are the regulations and what are the rules for each of these 2 entities?
I think basically what you're looking at really is to wonder which of the 2 forms would be a better entity to incorporate for your business. Now, typically the private limited company is really a tried and tested route for use as corporate vehicles. Now, there are some advantages that an LLP offers. Like, for example, the whole process that a company has to go through in terms of management, setting up a board of directors, holding meetings for board and shareholder. All these are not really applicable to LLPs. So internal procedure for a company is a little more cumbersome than it is for an LLP. Okay, the method of forming an LLP is far more easier and less cumbersome than a company. The LLP is governed by contract, which is the LLP agreement itself, and not by statute like the company. Now, having said all this, there are also some disadvantages to being an LLP. First is that it is a fairly new kind of structure that has evolved in India. Now, the robustness of this in terms of startups, particularly where you don't have a very long-term plan, is still, I think, a little unclear. The other advantage of basically setting up as a company is that in terms of funding, in terms of raising loan, in terms of issue of instruments, in terms of listing, are fairly established for companies as compared to an LLP. Okay, so I think if you are a startup company which is particularly in the IT space, which means you would also probably be looking at funding in the next couple of years, looking at perhaps at a later stage doing a listing of your company, then a company may be a better structure for you to establish.
So what are the procedures that we need to have in place before we can start accepting cash flows into the new company?
By cash flows, you mean
payments from servicing projects or some other projects that we undertake for other people?
I think at a minimum, once you incorporate, there are few registrations and licenses that you need upfront.
Okay.
One would be your PAN and your TAN registrations, which are your tax filing registrations.
Yes.
You'll also need your TDS numbers. You'll also need your VAT or service tax registrations if that is required for your activities.
Okay.
You'll need at a minimum a shops and establishments license.
All right.
And I think that should be reasonably sufficient for you to sort of start your activities, start invoicing and receiving payments.
All right. Also want to know what are the best practices that we should follow while setting up the company in terms of the structuring of the share between the partners and also the clauses that need to be laid down in the memorandum of association and the articles of association.
You should ensure that the agreement between yourself and your partners is fleshed out in writing, pre-agreed in terms of your rights, responsibilities, exit, etc. And that document should be reflected in your articles of association. Then the last is obviously to ensure that there is corporate governance in the functioning of your company. Your internal team, your accounts, your company secretary who's looking after compliances can also help you develop those corporate governance practices.
Okay.
A company structure may work best for Aaron, but may not for Roshan. Up next, Roshan meets Ramesh Vaidyanathan of Advaya Legal for some advice.
Rules of the Startup Game. The Startup Guide to Startups.
You have a dream? Well, we have this structure. In the first of this series, we are looking at private limited companies and limited liability partnerships through the eyes of two startup entrepreneurs. Aaron picked private limited company, and looks to me that Roshan is going to go the LLP way. For his real estate advisory venture, Roshan wants the advantages of both a company and a partnership. So he's meeting with corporate lawyer Ramesh Vaidyanathan to better understand limited liability partnerships.
Good morning. So I would like to take you through the way we are looking at the business. So we as the advisory firm will come along with the investors, will form an LLP who would own a project, and the project will be developed by a separate developer who would be only as a contract on a contract basis to develop the project. And the decision process as of now, what we have thought is in this flow, that the investment decision option will be decided by the advisory firm, post which the type of project and the best option available, how these three steps will include all the details of the project, and post which there will be approval by investors, and then the approval by investors and the advisory firm will be crystallized in form of an LLP, as in the documentation as well. Post which the advisory firm will take up all the compliances as well, as much as possible, and then pass on to the project and project for execution to a developer, post which the developer will exit, and later even the LLP can exit the project.
Okay, I think in your model, I think it's a very good, interesting model, I must say, and a model which is increasingly becoming popular, which is the owning of real estate through limited liability partnership models. It's actually a hybrid model, so therefore it has the best of a partnership model as well as a company. So therefore, to that extent, the liability is limited. Therefore, there's no personal exposure. But at the same time, it is a body corporate, so it has its own corporate existence. So there are distinct advantages of a limited liability partnership. In your case, to look at a limited liability partnership structure for each unit is an interesting concept. One, it has the advantage of isolating the risks of a project to a particular entity. Therefore, that's a great plus. The other plus is that, let's say, if you want to have different kinds of investors investing in different types of assets, you can actually have a multiple portfolio of projects under different LLPs, and therefore multiple style of investors or characters of investors. The key in your case would be how you structure the agreement, the limited liability partnership agreement. What kind of rights do you provide for? What kind of transparency that you build into the agreement, because the level of transparency will have a direct correlation to your attractiveness as an investment proposition.
So how can we bring in the transparency aspect before we form the LLP, or before when we are trying to get the buy-in from the investor?
One is, of course, to inform them that the decision making process is going to be as follows, and basically set out how each decision making will have a certain basis, certain explanation, and a certain visibility to the entire investor group. That's one. Secondly, what's the kind of audit mechanism that you can build into the agreement? Because if you can ensure a comprehensive, regular, independent audit, that can go a long way in ensuring that you're perceived as a transparent structure. Thirdly, the valuation mechanism that you will choose for an exit or an entry. Let's say you have people entering at different stages of the project. What's the kind of valuation you will embrace?
So having a separate LLP for each project is completely feasible, and we can have two projects which have same partners but different projects. Is that possible?
Very much possible. Very much possible. You can have multiple projects for limited liability partnership. You can have, let's say, you have a certain project. Because it's real estate, you have a certain lifespan of the project. You can define what's the kind of returns that you will want to exit at, let's say, so those kind of things can, so to that extent, it can be a limited life, limited tenure kind of life. So there's no problem at all in having multiple limited liability.
Okay, and also the same investors can be part of one or more projects as well. There is no constraint.
Absolutely, there's no constraint at all.
There's no constraint at all.
You will find over a period of time that your investors are the ones who are going to be giving you repeat business.
So exactly. So that was the reason. And also, I had mentioned that we as advisors would get into the project as into the LLP, but at the same time, we won't be bringing in any funds on board. But it would be more, we would be driving the decision making. We would take all the research or anything that has to be done, as even the legal compliance will be done beforehand, and then only then it will be handed over to the developer to execute the project. So in an LLP, is it possible to have something in form of sweat equity that is generally there?
Very much possible. Only thing is you have to have a mechanism to value that. You have to have obviously a just reward for the effort that you put in, and the fact that you're actually sticking your neck out and taking on the onus for, let's say, obtaining approvals, identifying, let's say, a contractor, going through a bidding process, assuming, for example, in order to identify a contractor, and you're to some extent vouching for the completion of the project and things like that. So the sweat equity should be in proportion to the effort that you put in, and it should not be perceived to be higher than what it ought to be, and it could be pegged to certain deliverables on your part, certain bottom line targets on your part, which is typically in the context of PE and those kind of
so
deals.
on a similar line.
On a similar line, because I don't think you should work on a granted or guaranteed sweat equity. There should ideally be either an upward or a downward revision of the sweat equity proportion. based on the value that you manage to eventually bring to the project.
A private limited company for Aaron and a limited liability partnership for Roshan. Sounds great. But what about the tax implications for both? Well, that's coming up after this break.
Rules of the Startup Game. The Startup Guide to Startups.
You may not enjoy paying them. Hell, you may not even make enough right now to have to pay any, but there's no avoiding taxes. So it's very important that before they pick the right structure, our startuppers get the lowdown on tax liability. That's where Roshan and Aaron are now headed to meet tax consultant Rajendra Chitle.
Roshan and Aaron, I have gone through your structures and your kind of approach and so on and so forth. And broadly, it's on track. The fundamental difference between the LLP structure and the company structure is, from a tax standpoint, the LLP structure results in two very important tax efficiencies. One is the LLP structure doesn't have a dividend distribution tax. So effectively, as partners, okay, including investors as partners, when they get any share or any return on their capital, whether in the form of, in a company, it's either in the form of dividend or in the form of interest or in the form of capital gains. Whereas in a LLP, typically when the business is ongoing, if profits come from that and there is a dividend distribution tax in a company, that doesn't apply over here. So it's a seamless one level corporate tax. Okay. So what happens is any business will always pay tax on the profits at one level. But thereafter, often enough, it is not that it is tax-free in the hands of the recipient investor. Take a company. A company, as a shareholder, there are three ways you can get profits out. One is dividend declaration, in which case there is a dividend distribution tax. Second is a share buyback, in which case there is a capital gain. Third is sale of shares. If it is not on the market, again there is capital gain. So over here, dividend distribution tax does not apply. If finally you keep on divesting, like in your case, properties from that particular LLP and return cash, there is A, no code-driven process for reduction of capital, and B, there is no incremental tax once the partnership has already paid tax. So structurally, I think LLP is a very important happening in the country for new businesses as well as existing businesses. So I think that's something that might be useful for you to think through.
I was actually curious about how do you go about filing your returns for the company at the end of the financial year, and what are the requirements that you need to do periodically throughout the year so that the whole process can go on smoothly when it comes to filing your returns at the end?
Well, I think procedurally it's fairly simple. You have to file a tax return once in a year, and that's typically about 6 or 8 months after the end of a financial year. And therefore your financials, etc., would have been ready before that. And otherwise, you have to pay advance tax based on your estimated income for the year. That's to be paid from June, September, December, and March quarters. And that's pretty much the compliance. Of course, you have to ensure that you are registered under the tax laws. You get your PAN, you get your TAN number, etc., etc.
When we take up a particular let's assume that we are doing a particular project on partnership with an external entity. We are sharing profits. So in that case, what are the clauses that we would need to maintain, and how do you distribute those the income that comes to that project to two different entities?
If the arrangement is such that that project itself becomes a separate tax entity, like an AOP, the whole tax consequences will be very different. Instead of that, if it is a contract between two principals of service provider, so one of them is taking over the project and other is really a service provider to that, then the consequences would be very different. So I think what you need to understand when you're doing any projects is avoid situations where you'll have the project itself being treated as a separate tax entity as an AOP.
Alright, so you would recommend you go by one person takes up the project and the other services a part of it?
That's right. That would be preferable, because otherwise you are creating another tax entity. It will have its own compliances, and AOP has its own way of taxation, and you will be a member of the AOP as a company, and then your cash flows would not be taxable in your hands. Then what will happen to the expenses which have not been incurred in that JV but incurred in your books? Those will get disallowed. So it wouldn't be as seamless as it would be if the entire top line were to come as a taxable or top line into your books.
I understand that in this case, when the investors are putting in their money, they will only be taxed only once.
Correct.
So they won't have to pay tax, and they don't have to worry about when they take that money into their own hands. So once it is taxed, it is tax free with them.
Once it is taxed in the hands of a partnership, it is tax free in their hands.
And they can use it into their own income statement as well, and it can go in there.
Yeah, it goes in as a entry as a share of profit in the partnership, which is tax free. It is exempt under section 10.
Sir, the tax application, will it happen at every time whenever there is a sale of the property, or would it happen at the termination of the LLP?
Well, income tax is applicable on the profits of a financial year. And under the tax law, there is a fixed financial year which is April-March, 1st April to 31st March. Now, in a real estate situation, okay, there is a question of what is your method of accounting for determining the profits of the project. Okay, by and large, there are two principles. Okay, one principle is that you need, once there is a sufficient pre-sale, then you cannot postpone the entire profit recognition till the time you complete and hand over. Okay, but this is an ongoing debate between the tax authorities and the developers, but largely speaking, it is not going to be tail-ended unless you just create an inventory, and then once the whole property is built, you are selling it as an inventory.
Once you've found the right structure for your business, there are a few more things you need to do before you can open shop. Find a name, register your company or partnership, and open a bank account. And they all are a little tougher than they sound. The registration process for a private limited company starts with submitting at least 6 company names via Form 1A to the Registrar of Companies, or ROC, in the state where the company wants to set up its registered office. The approved name is then valid for a maximum of 2 months. Within this period, the promoter needs to register his company, and to do so has to file several documents, including the Memorandum of Association, the Articles of Association, a Declaration of Compliance, and information on the directors. The ROC grants the Certificate of Incorporation after vetting these documents, and only then can the company commence business. The process for naming and registering an LLP is similar to that of a private company, except that it involves just one document, the LLP agreement. Nowadays, both a company and an LLP can be registered online using the Ministry of Corporate Affairs website. Thereafter, your company or partnership needs a bank account, which in turn needs a whole host of documents to be submitted to the bank. That list includes a certified copy of the Memorandum of Articles of Association, a certified copy of the Incorporation Certificate, a board resolution of all directors to open the account and authorization for its operation, and a few more such standard documents. You think that's a lot of paperwork? Wait till you see next week's show. Next week, we return with 3 more entrepreneurs to wade through the minefield of government registrations, factory licenses, a whole host of municipal permissions, IP protection, in short, lots more paperwork. Make sure you tune in next week to Rules of the Startup Game. And if you have any questions, remember to write to us.
Rules of the Startup Game. The Startup Guide to Startups.